In this video I will show how the real structure looks like. I think you have learned the structure in this way. The structure is always higher highs, higher lows, and the market just moves simply like this. It's all fake, bro. If the market moves like this, everybody will be profitable in the market. They will buy from here and they will target this, they will buy from there, they will target this. It's all bullshit, bro. The market don't move like this. The structure is a liquidity trap. The structure is a liquidity trap. This is how the real structure looks like. Assume there is a demand zone from the higher time frame here, and this is the liquidity sweep. This is the real break of the structure. This is the mitigation. This is the target. This is how the structure works. And if there is supply zone from the top here, the market will give you a fake break of the structure first, and it will liquidate the early sellers, and then the market will drop. This is the real drop. This is how the structure works. The real move occurs only after the liquidity is taken. Liquidity is the fuel for the price. Liquidity is the fuel for the price, not order blocks. Let's check here. Can you see the structure here? Higher highs, higher lows. See here. What happened is it liquidated this, and this happened. This happened. See, many smart money people. What smart money people will do is after this break of the structure happened, they will sell from here. They will sell from this order block. They will sell from this order block. But what we do is we wait for the smart money people to get wiped off in the market, and we will enter here. After this reaction, we enter here with a fixed 4 pip stop loss. I can't take more about entries here. Only I should teach in the mentorship about the entries. This is our entry. See, the same thing happened. After this break of the structure, again, many smart money people will look for sells, right? Sells. Many smart money people will look for sells. So see what happened. We will be in the buys here. We exactly do the opposite of the structure. We don't follow the structure. We exactly do the opposite of the structure. Target this. This is we enter after the liquidity is taken, and we target the liquidity. We don't enter on bullshit like order block something. We just enter on liquidity and exit on liquidity. This is our strategy. Nothing fancy. I am explaining about the common 1 minute criteria. It's same for 4 hour daily, everything. It's same. See, the same thing happening over and over and again. After this liquidity is taken, again the price dropped. Can you see? Again the price got dropped because the structure is fake. The structure is fake. The liquidity is the real move. Liquidity is what moves the market. See, can you see? After this liquidity is taken, the price is again going up. This is called expansion of liquidity. Let me draw in a clear picture for you. Expansion of liquidity. This is called expansion of liquidity. Many retail people don't like this type of trading when the market is moving like this because they can't trade either way. This is called range. This is the favorite phase of the banks because in the range maximum orders are and maximum money is collected for the banks because many people are getting trapped in the range. See, if you are a trader like that, the ranges are very profitable for you. Ranging markets are very profitable. See how the liquidity is moving. Sell side liquidity is taken and buy side liquidity is taken. This is the market liquidity cycle called. This is what the liquidity cycle is. If the sell side liquidity is taken, we should assume the buy side liquidity to get taken out. If the buy side liquidity is taken, we should assume the sell side liquidity to take it out. If the sell side liquidity is taken, we should assume the buy side liquidity to take it out. This is the liquidity cycle. Always the price moves from one pool of liquidity to another pool of liquidity. There is no shit bullshit like order blocks, retail concepts, trend lines, etc. I will show you even in the monthly chart. The same phenomenon occurs in the monthly chart. There is a clear price build up in the monthly time frame. This is the build up in the monthly time frame. Stacking liquidity, the monthly time frame stacked liquidity, and this is my target. It can take 2 years or 3 years to achieve this target, but I am very bullish in the current scenario. And this thing is called what structural liquidity. I can't talk about this here because of I signed NDA with some of the mentors. This is called structural liquidity. See, exactly from this point, if you see in any time frame, like I think in 15 minutes it works best. Exactly the price sweep it with a little bit and reverse it. This is the power of liquidity. Can you see? It swept the monthly structural liquidity very little bit, and these are not structural liquidity. These are the higher time frame liquidities. These structural liquidities are these ones. See, this is the structural liquidities. In this leg, the structural liquidities are, if the price still want to continue lower, the price can do this. It can react from the structural liquidity or this structural liquidity. Yeah, these are the two structural liquidity levels in the monthly time frame. These are very strong. We can expect an intraday reaction or weekly reaction because this is the higher time frame liquidities, right? The 1 minute liquidity is the lowest reaction liquidity. It can give good reaction in the 1 minute time frame, but the monthlies is very extremely high important liquidities. This is how we see the liquidities in the market, and this is my previous day high. Previous day highs and previous day lows are very important in the liquidities because it's the where the main move occurs, where the bank real moves occurs. See how the smart money people are taking out in the market. Again, the smart money people will assume buys sells from here because they see it as a break of the structure and cock something. See, and the smart money people assume buys from here. There is a clear order block, and you see sweep from the left, engulfing. Smart money people get wiped off here. They get wiped off here, and again the smart money people get wiped off here. See how many times the smart money people are getting. How many smart money traps are there in the market? If you want to avoid these traps, we should just enter after the liquidity is taken. The only tip I can give free for you guys is understand and think where the many people, majority of the crowd, sheeps are entering into the market. You should just do opposite. The market maker intention is to trap the pool of sellers or buyers in the range of the market and manipulate into the one side of the market and then go the opposite side. This is what I will draw here for you. Accumulation, manipulation, distribution. This is the cycle. They will accumulate. This cycle happens in 1 minute to monthly time frame. I showed you just before now, right? Monthly time frame. Accumulation. Every candlestick formed by this cycle, accumulation, manipulation. This is manipulation. And this is called distribution. First, the banks will accumulate orders and they will manipulate. If they manipulate to the one side, here the two types of traders are get wiped off. Here The retail traders will look for buys from here, and the smart money will look for order block from here. But what we do, we just enter the sell here because the buy side liquidity is taken, right? So we target the sell side liquidity. This is how we maximum avoid 90% of the traps, but no strategy is 90% accurate in the industry. We have good win rate when compared to the retail and smart money concepts. That's all for this video, guys. Hope you like the content. Subscribe the video.